There are three primary ways to calculate cash flow in your business. The first one utilizes the income statement. The second one utilizes your bank account. And the third one utilizes something that's fairly common for accountants, but may not be something that most people inside of working businesses have seen all that frequently. So first, let's talk about utilizing your income statement. The income statement is also often referred to as the profit and loss statement. And on that statement, there are things like revenue and cost of sales, gross margin, operating expenses, operating income, net income, and the like. For our purposes, we're really just going to talk about starting with the very bottom line. And purists out there may argue with me that that's not the best place to start, but we're going to assume that it's indicative and is really most relevant for the people who are watching this video. If you start with that bottom line, what you'll want to do from there is then consider cash inflows or payments that are not reflected in that profit and loss. Here are some examples of each of those. So cash inflows might be proceeds from a loan that you've received. This could be a line of credit, it could be a term loan. I'm not going to include credit cards in that process, but those could be included as well. You may also receive investment equity from investors or from current owners of the company. Cash outflows could include debt payments. They can include owners' distributions or dividends to either owners or investors. They could also include purchases of capital assets. So that could be machinery, equipment, vehicles, office furniture, anything that has been included in the property and equipment section on the balance sheet. So taking those pluses and minuses off of the income statement will help you see where you stand from a cash flow perspective. It is very, very possible to have a nice, healthy, positive number at the bottom of your income statement and then subtract those other payments that I just talked about and find out that you've got a negative number. And generally, that's a little eye-opening for businesses, whether that be the management team or the business owner or the CEO. But it also helps explain why you can feel profit rich and cash poor. The second way to approach a cash flow is to do it really through your bank account or bank accounts. And what I mean by that is that cash flow truly at its heart is a beginning cash balance plus what comes in the door and is actually received minus what's going out the door to come to an ending cash balance. And cash flow are those two things in the middle, the cash in minus the cash out. Now, if you have a healthy bank account balance, if that net number is negative here and there, it probably doesn't feel that contracting to you. Maybe that is why you have a healthy bank balance because you know that there are ebbs and flows and maybe timing issues in your particular business or company. If you don't have a healthy cash balance and rely on that monthly cash flow really funding what's happening in the business on a more current basis, that can start to be a little stressful or maybe a lot stressful. I'm not a fan of managing your business through your bank account. I think it makes certain decisions more or less meaningful as the case may be. It's very hard to have a long-term perspective when you're managing your business through your bank account. So while you may want to include it as a component, while that may very well be your methodology for calculating cash flow, I would encourage you to surround it with some other financial analysis tools, including, frankly, looking at your income statement. Now, the third way that you can calculate cash flow is through a more involved method called a cash flow statement. You'll often see these for companies that have gone through some sort of audit, who have financial statements that are prepared by an external accounting firm. Publicly traded companies always have a cash flow statement. And that cash flow statement starts with generally net income and then looks at the changes in the balance sheet and separates those changes into three categories, which are operating, financing, and investing. And each of those categories looks at different types of company activities or business activities and puts them into categories so that you can see of your net income how much is being added to or subtracted from by changes in the balance sheet. And some of the ones that we talked about earlier, including capital expenditures and debt payments, are reflected on this cash flow statement. But some of the other ones that get considered are changes in the working capital accounts. And I know that sounds like a very fancy term, but it's things like accounts receivable and accounts payable. A cash flow statement done in this manner is usually the most helpful and worth the effort for companies that are working capital intensive, often equipment intensive, relying on lines of credit or other types of funding mechanisms. So they have a lot of moving pieces, and really understanding how each of those is working and how they are adding to the cash flow position of the company can be very, very important. For some businesses, it's overkill, and the trouble of putting one together simply isn't worth the effort. You could get as much information using one of the other two methodologies. I would encourage you to think about which of those might be the best for your business. If you want to do the third option, if none of those categories or very few of those categories apply, it'll still be super simple. It'll be straightforward because you only have to consider what applies to you. You don't have to consider those things which don't. So what I'd like to know in the comments is, are you using a cash flow methodology? Are you using one of the calculations that we walk through? Have you tried various cash flow calculations, and how often are you doing them? Much of what I described is usually done on a monthly basis, simply because that's the timing that seems to work the best for a lot of companies. And it gives you a much more holistic view of everything that's going on, because certain of those activities, debt payments, distributions, and purchases that are significant often only happen monthly, and sometimes not even that frequently. So what have you tried that's worked? What have you tried that hasn't worked? If you got some ideas from today's video, let me know which one your favorite was. And please remember to subscribe to our channel so you can get more updates and hear more information about cash flow.